Welcome to Catalyst. I'm Seana Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's take a look at the three catalysts that we're watching this hour.
First up, we'll break down the market action as Wall Street casts caution on the latest rally.
Plus, from trade to tax cuts, we'll break down what the latest developments out of Washington mean for investors.
And a challenging fundraising environment has venture capital under pressure. We'll discuss all that and much more on Catalysts. U.S. stocks pulling back this morning after the S&P 500 hit a new record high, the third of the year. Scott Kroenert of Citi warning the near-term high is likely due for a pullback, but he does add there's no change to the long-term outlook. Here to break it all down is our very own Josh Schaefer. And Josh, I can't wait to get your thoughts on this note because I thought it was kind of interesting. He sounded like Jay Powell to me, like leaving himself open to potential rally, potential move to the downside. Not sure where the market is heading.
Yeah, it seemed like what Kroenert was highlighting to me is essentially a lot of the good news in terms of Trump policy feels like it's priced in at this point, and especially in terms of tariffs, right? I think a lot of people I've been speaking with recently have sort of had this thought where it seems like the market at this point has priced in that 25% tariffs on Mexico and Canada are largely negotiating tools. So the fear would be, what if they're not a negotiating tool, right? And what if those tariffs actually do come to fruition in the next couple of weeks? I think we saw perhaps the last time we got near the tariff deadline at the beginning of February, right? We had sort of that overnight sell-off. We'll call it a sell-off. Stocks were down about 1%. But for us in this market, a little bit of a sell-off, right? But then that sort of faded as the day went on, right? And we found out that the tariffs were getting delayed in Mexico and then the tariffs were getting delayed in Canada. So it seems like what Kroenert is essentially saying here is the upside surprise is probably already priced in, and really you probably only have downside surprises to come in terms of tariffs if we do actually get full tariffs. But as you point out, Maddie, I think overall the takeaway also being he thinks that doesn't necessarily mean that the S&P 500 would be in trouble for the entire year, more so talking about perhaps a short-term drawdown.
Yeah, and I think a lot of this just points to so much uncertainty that's out there. And one of the things that we've been talking about, obviously a theme, and it was also a theme in a recent survey of CEOs and business leaders, just in terms of the fact that they are maybe a little bit worried about what the future could bring, but they are overall optimistic, which I found a bit perplexing, just given some of the headlines and given the fact of the lack of deal activity, for example, since the start of the year, would make you think that maybe they weren't as optimistic as they
Yeah, so the Conference Board survey of CEOs was out this morning, Seana, and it hit its highest level. The overall index hit its highest level in 3 years. Pretty large jump you're seeing on your screen there all the way to the right. And what was sort of driving that, it seemed like, was, again, as you said, optimism on the current economic outlook, optimism on the next 6 months, which I found rather interesting, that they think the next 6 months is actually going to be better. I don't know if a lot of economists think the next 6 months is necessarily going to be better, perhaps maybe the same and not worse. But other key takeaways from that for me were sort of the overall employment situation that was highlighted in there, more signs of kind of the low hire, low fire environment. A lot of CEOs plan to hold on to their workers, which is good news for all of us that have jobs, right? And as Jay Powell said, it's a good environment where you have a job, right? And CEOs are planning to also raise wages for those workers, but they're not planning to hire. Less CEOs saying that they're planning to hire in the next year overall. So it seems like, again, kind of steady state right now. But again, I would sort of say the bad cut here would be if they felt like they were going to be firing people, right? Or laying off workers or cutting back on the workforce. And they're not. So I think overall a positive spin from CEOs, which is a little bit different than what we've been seeing from consumer sentiment.
And a lack of hiring is tough when you have a record-breaking layoff happening to the federal government and the impact that could potentially have. I do want to switch gears a little and talk to you about this line. Kroenert saying the Magnificent Seven will contribute but not lead the market gains. What is the leader then? Is it a specific sector or is it just general individual stocks keeping us afloat?
I mean, it seems like we'll go, if it's not the Magnificent Seven, it's definitely the 493, right? Within the 493, I mean, a lot of strategists right now are still talking about financials. They seem to like financials, right? If you're going to stay in tech, that AI software trade has also been doing very well to start the year, and that's been an area of the market that strategists seem to like. But Maddie, to Kroenert's point, I think, again, what he's getting at with, if we have less Mag 7 contribution, it's going to be a different ride up than what you've had the last 2 years. You got the rally of over 20% for 2 years in a row because these giant stocks were contributing a lot to the S&P 500's gains. I know our Seana Smith highlighted yesterday in her chart of the day, those companies are not contributing as much, right? And so if you don't have as big of a contribution to the index from the Mag 7, you get a little bit of a smaller gain, right? We don't have NVIDIA driving up this index right now.
Yeah, which I think is so interesting. And then that also begs the question whether or not market breadth is good for the market, it's bad for the market. There are some contrarian takes out there that are starting to emerge, and just talking about the fact that it's going to limit some of that upside, just given the fact that it won't have that outsized impact as big tech.
It depends on what you own, right? It's good if you're a stock picker, right? And that's why strategists love to talk about it, because they love to be stock pickers. Yeah. And there are more companies, as we've been highlighting this week, there's almost half of the index is outperforming the index thus far this year. So there's more opportunity if you're going outside of just the Mag 7 to find a company that's going to do better than the index. So if you're looking to be that kind of investor, it's perhaps, if nothing else, just a more entertaining market to be an investor in. You don't just have to own 7 stocks and say, well, I don't know where else to go. There's other opportunities within the market.
Could make it a little bit more challenging to find those winners.
It's not easy to stock pick.
All right, Josh, thanks so much. Let's take a look at gold, because gold actually hitting a fresh record. It's the 11th intraday high of 2025. That's according to the data that we have here at Yahoo Finance. Geopolitical tensions, tariff risks are continuing to persist. That's adding some of that safe haven mentality. Markets and data editor and host of Stocks and Translation, Jared Blickery, joining us now to break it all down. Jared.
Thank you, Seana. What a great day to talk about gold. As you mentioned, lucky number 11. That is the 11th record high of the year. And the chart, if it shows up here, you're going to see you don't get a much more steady chart than what we have in gold since the beginning of the year. Here's 3 months, and you can see up 12% in that time range. And I just want to point out, we are still short of 3,000. This was a high this morning, 2,973. It's $20 off of that. But we just keep inching closer and closer. And I want to show you how gold has been on investors' minds recently. This comes from the Global Fund Manager Survey done by B of A once per month. And this is the top currencies that investors expect to outperform in 2025. So this is a prediction. I want to point out that US dollar is still number one, 31%, but that has been on the decline over the last several months. Japanese yen, we don't talk about that a lot. That is on the increase. That's up to 30%, threatening to take over the dollar. But gold has been rocketing higher too in the survey, and that is now at 25%. So gold, definitely one of the most important currencies that the world has its eyes on this year. And it's not just individual investors, it's not institutional investors, it's not the retail gold buyers, it's really the central banks who make the biggest decisions with respect to gold. They have been buying the most of it. And when I think of that, it's China and Russia over the last 10 years. But this is really interesting because this comes from the World Gold Council. This is the 2024 largest purchasers. And guess what? Poland is number one, over 80 tons. Turkey, number two, pretty close behind. India, close behind Turkey. And then China, over 40 tons, that's number four. But let me show you how China has been adding to its gold reserves over the last 3 years. This chart goes all the way back to 2010. In 2011 was when they really started ratcheting up the purchases. And you can see they were adding over 400 tons per year. That's this white line right here. Then in 2021, they just started, or 2022, they started blowing that away. 22, 23, 24, almost double that. We're looking at 1,100 tons per year. So getting back to our original premise here, what is gold going to do this year? I think it's an easy bet that it gets to 3,000, but I just want to show you historically what it has done in times of trouble. It's not only an inflation hedge, but also somewhat of an Armageddon hedge, but it's also a little bit misunderstood. In 2008, we did have a pretty big downturn in the midst of the global financial crisis. And so gold suffers from deflation. It is kind of a risk asset, even though it's also a bunch of other things. But then we saw the peak after the QE era in about 2011, 2012, still had some strength around $1,800. But then as the Fed started, kind of winding down QE and it started tightening, we didn't really see gold take off for a number of years. Here's a pandemic, and then we finally got this breakout here. Based on history, we've got a ways to go. We'll have to see where we end up.
All right, Jared, thanks so much. Keep it right here on Yahoo Finance. Coming up, the policies impacting chip companies. We will be speaking with the CFO of Lam Research. He joins us next following their Investor Day. We'll be right back. Uncertainty continuing to surround chip stocks as investors weigh the effects of policy changes with stricter U.S. export controls and potential tariffs on the way after President Trump proposed 25% tariffs on chips. Joining us now, we want to bring in Doug Bettinger. He is Lam Research's Chief Financial Officer. Doug, it's great to have you here back on Yahoo Finance. So the last time we spoke was just about 8 or 9 months ago. You were telling me that supply, that demand looked very, very strong. You were very optimistic about the remainder of what we saw last year, also heading into this year. I'm curious, just with President Trump and the Trump administration now in the White House, does that at all change that demand dynamic?
You know, at this point, no, it really doesn't. You know, we had our first investor day in 5 years yesterday. We talked about what we see into the future. You know, the government regulations that are there kind of feel like we're in a steady state pattern right now. So at this point, no, nothing new that we're aware of.
Speaking of the demand question, though, it's been interesting to hear from CEOs and executives, even at the likes of Microsoft, saying that the chip shortage is coming to an end. How does something like that impact your business?
You know, when we look into this year, frankly, it's going to be a pretty strong year for semiconductors. You've got all of the demand that is originating from the AI investments that are occurring. That requires a lot of semiconductor content. And frankly, we supply the equipment that manufactures the chips. And so when we look into this year, it looks like a pretty good year, to be honest with you.
What does that demand more specifically look like then, Doug? The growth opportunity, how that compares to last year?
Yeah, no, we see growth in the things that we do. You know, it's up mid-single digits relative to where the investment in wafer fab equipment looks to be trending this year. And that's investment that generates all of the leading edge chips in the industry. And so we're feeling really good about where things are trending right now.
In your conversations with customers, how do you drive them to upgrade when you offer new tools like the ones that you announced at your investor day? Because you could argue that once they have your existing tools and TSMC is able to utilize your tools to make the chips that their customers want from them, why would they spend the money to upgrade?
You know, the need to continue to innovate with leading edge capability, higher performing chips is always there. And that's actually what a lot of our equipment enables. And frankly, that's what we see going on, right? All of our customers are moving to that next process node to get the next level of performance. AI is driving a lot of that right now, but the demand for semiconductors, broadly speaking, is actually quite good this year.
Doug, how difficult is it to give guidance and to really navigate a time where there is so much uncertainty coming from Washington?
You know, it originates from conversations with customers, right? We understand where they're going, we understand what they need, we understand what their roadmaps look like, and frankly, that is the basis of trying to understand where business is trending. And honestly, if I can kind of point to a little bit of what we talked about longer term at our investor day, those conversations with customers are requiring us to make investments to grow the business as we look forward over the next several years. We're very excited about where things are going.
Doug, have you been having any sort of conversation with the Trump administration or your peers even within the industry just in terms of how the next several months, several quarters could potentially look?
Yeah, listen, we've got a very strong government affairs team. That's their job, that's their role. Yeah, conversations are beginning, but what I would tell you is it's early days at this point.
Right, but we have you here with us now, Doug. What are those conversations looking like? Can you give us anything?
Yeah, like I said, early days, too soon to comment on any specifics.
All right, well, I also want to talk to you about something specific, which is the United States relationship with other countries, specifically when it comes to rare earth minerals, something that the Trump administration is trying to reach a deal with Ukraine currently. It's obviously been an issue with China and their control of exporting of those rare earth minerals that, in my understanding, are utilized in some of your products. How have you shifted and strategically thought about shifting your use of those minerals ahead of any of those tensions that could escalate concerns about your ability to get access to the materials that you need for your chips and your tools?
Yeah, frankly, we're able to get everything that we need, honestly. We've got a very capable supply chain organization at the company. Really hasn't been a significant problem for us, to be honest with you.
Doug, when you talk about that strong demand, I'm curious, just where is that coming from? And what do you see driving that here in the months to come?
Yeah, honestly, when you look at like the new demand driver that we see in the industry, frankly, it's coming from AI. All of the GPUs that enable AI training and increasingly moving to the inferencing side of the house, the ASICs, the low latency DRAM, high bandwidth memory, all of those things need next generation capability. And that's what we talked about at our Investor Day yesterday. We looked forward over the next 3, 4, 5 years. And honestly, we see the opportunity to double the size of our company from a revenue standpoint and more importantly, from a profitability standpoint. I think yesterday, that's what got our investors very excited about what's going on, specifically with our business, driven by what's going on in the industry. Great roadmap ahead of us. And we were excited to announce 2 new products yesterday. A product we call Akara, which is the first bottoms-up redesign of our conductor etch tool offering, as well as a tool we call Halo, which is going to enable the next evolution of metallization in the industry. Super excited about the strength of our product portfolio and what that's going to do for us as we go forward here.
If you look at the stock on the Yahoo Finance platform, you can see the PE ratio at 27. Investors excited about how cheap the stock is compared to the rest of the semiconductor industry. So we'll certainly continue to monitor all those company developments. Doug, thank you so much.
Excellent. Thanks for having me today.
Now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Mercedes-Benz expecting a challenging year ahead, announcing plans to cut costs after sales fell 4.5% year over year for 2024. Yahoo Finance executive editor Brian Sozzi spoke to Mercedes CEO specifically about President Trump's proposed 25% auto tariffs. His message to the administration is to not forget how much the company has invested in the U.S. here, saying, quote, "We are also an American company. Yes, we have our headquarters in Germany and we have European origins, but we feel American. We are prepared to continue to invest billions and we want to grow our footprint in the United States." That is really interesting in the context of their EV sales in particular, which were under pressure in the United States, under more pressure globally. If you take a look at Europe, we saw those sales declining by 4%, the growth just decelerating in the United States, and the guidance indicated that growth was only going to continue to slow. There was no evidence of an EV snapback in the cards for Mercedes. So something else that I am thinking about here is not just the impact on Mercedes, but also if we can pull up Tesla stock, you'll be able to see that stock is also under pressure, even more so than Mercedes. Last time I checked, you can see Tesla's down about 2%. So potentially a little bit of a read through to Tesla when it comes to that demand.
Yeah, certainly. And I think this just very much focuses on production costs and the ability here for many of these larger automakers. Obviously, when it comes to Mercedes specifically, the ability to lower those production costs in a timely manner and what essentially that looks like and how much more complicated that is going to be under the potential threat of new tariffs. And specifically when we don't know, when there is so much uncertainty just about the scale and scope of these tariffs, what that's going to look like, lays out what has really been, I think, a critical challenge here for the industry. And we've heard so many CEOs talk about this within the auto industry, even here in the US, just about the fact that it is tough to plan here for the next several quarters and next several years, just given some of the changes and the whiplash that is coming out of Washington. You're also seeing that reflected in the global auto market as well. So again, when you talk about the fact that margins could be under a bit of pressure here, you talk about the fact that the company expects margins to be between 6 and 8% in 2025, looking ahead to what that could potentially look like in 2027 if they are able to meet those cost-cutting plans that they do plan to do. So again, I think it very much just begs the uncertainty question, and I think that very much just shows how fragile this industry is potentially in regards to some of the policy that's coming out of Washington.
Especially to your point, because costs were already such a concern.
Yeah. All right, let's take a look at Disney's plan to deal with Fubo TV. It's actually under scrutiny. According to a report coming out from Variety, Democratic Senator Elizabeth Warren is raising some questions here. She's urging the Justice Department to investigate the proposed acquisition, saying that it's, quote, another attempt to dominate the sports streaming marketplace and should be regarded as another data point in Disney's history of anti-competitive behavior. Now, in January, Disney announced that it would merge its Hulu Live TV service with Fubo. They would also take a 70% ownership of the combined company. You're looking at both stocks under a bit of pressure here today, but taking a look at what Elizabeth Warren said even more specifically, a lot of it was surrounding pricing and what that could potentially expose here for some consumers, saying that this proposed acquisition raises significant concerns under antitrust law, will give Disney increased market power and some of that incentive to increase costs for viewers. Also regarded the fact that she said that Disney has a history of some of the anti-competitive behavior. It's also important to point out this isn't the first time she's raised some of those questions, some of the concerns regarding this. So again, it's more of a double down of what we have heard her say in the past.
I think it's fascinating, given what we heard from the Trump administration this week, that they're going to continue what they called Biden-era regulation. Does that mean that the Trump administration is going to be on Senator Warren's side when it comes to pressure on acquisitions and mergers like this? It's going to be really interesting to see that. One thing that I'm just familiarizing myself with here is that this ended that lawsuit that Fubo brought against Disney, Fox, and Warner Brothers because they were planning their own sports streaming service that would have been competitive against Fubo. And then Disney said, well, let's just team up, Fubo, and then you don't have to sue us. And that's the question that Senator Warren is raising here, along with some of the other concerns that you pointed out, Seana, just that it does continue what she calls a history of Disney's anti-competitive behavior. So I think it's going to be fascinating to see how the Trump administration responds to this.
Maybe they'll find some common ground on this.
Maybe they will. Maybe they will. All right. Well, we will continue to cover all your markets action ahead. So stay tuned for that. You're watching Catalysts.
Take a look at shares of Palantir. You're looking at the stock off almost 10% here in early trading. The declines coming after the drop that we saw yesterday that initially came on reports that the Defense Department is making budget cuts. And also we had the news that CEO Alex Karp is adopting a new stock trading plan. That, of course, adding maybe to some of the pressure here today. But again, I think a lot of it has to do with the spending cuts when it comes to the U.S. government, the importance that is to Palantir's business. And here's why. When you take into account just how important the government part of the business is to Palantir, making up over 50% of its revenue, very much a lot of the growth within Palantir that we have seen has come from government here, more than 40% growth in the past 2 quarters. So they have that great exposure to any cuts in the U.S. defense budget, more exposure, you can make the argument, than many or all of its peers here when you take into account that much of their exposure is in the mid to high single digits here. So again, the fact that they do have that the government accounts for 55% of their total revenue here just really shows just how big of a hit maybe this could potentially be. Of course, there are some contrarian calls out there, Maddie, when it comes to Dan Ives saying that this actually could be a catalyst here for the stock in the long run, but at least there is concern here once again for a second day in a row surrounding Palantir. That's
exactly what I was just pulling up. Dan Ives' Twitter account, or X, he said that the Palantir sell-off, it's just the bears poking holes yet again. He says it's similar to the DeepSeek sell-off, just some noise and not something to worry too much about. But of course, Palantir investors clearly not seeing that the stock is down 10%. So how realistic are all of the cuts the Trump administration is currently touting to spending? According to a new memo from Defense Secretary Pete Hegseth, his plans for the Defense Department aim to reduce projected U.S. military spending by 8% over the next 5 years, sparing certain areas within the defense space, though, including border control. Joining us now for more, we've got Henrietta Treyz, a managing partner and the director of economic policy at Veda Partners. Henrietta, great to have you back with us. How realistic is Hegseth's goal here to cut defense spending, and what do you think that could potentially look like?
Yeah, thanks for having me. I think it's completely disingenuous, frankly. To say that you're going to cut 8% is one thing, but be aware that in the Senate, we have a bill that is going to be voted on later on today, authorizing what will ultimately be $350 billion in additional defense spending spread across immigration and military spend. So they could maybe cut around the edges and identify some areas to trim back. But on the other hand, and simultaneously, the U.S. Senate is moving forward with a bill that would exponentially increase defense spending. In addition, there's another CR, a government funding bill, that needs to pass by March 14th, which also includes a 2.7% uptick in military spending versus 2025. So I think if you're going to base this on what's going on in D.C., you need to look at Congress more than the White House.
So how do you see this netting out then?
I expect federal spending to rise throughout 2025 on almost every sector, defense and non-defense discretionary.
Can we talk about that in the context, too, of this idea from Musk? He teased out this idea of sending $5,000 checks to citizens following these cost-cutting measures, sort of like a dividend payment to the American public. How does that help DOGE with their goal to cut $1 to $2 trillion from the deficit?
It obviously doesn't. If you have $55 billion in savings, which is an inflated figure that their receipts do not prove, but let's just say it's accurate, providing stimulus checks to American voters is $1 trillion plus proposition. So the math does not add up. we do know that the president is very supportive of those individual stimulus checks because we saw them in his first term, and he very much liked signing those. And it was a huge part of the reason he was so popular during that time. So would definitely expect this to be something that they talk about, but obviously it would blow a hole in the deficit.
Yeah, Henrietta, how would this plan even work in practice? Could it?
It wouldn't. I mean, they have to get something through Congress. And right now, as we can see through the warring internal debate between the House and the Senate Republican conferences, they have not yet identified a path forward just to keep taxes flat, let alone provide stimulus checks of, I think you said $5,000 per person. It's entirely unrealistic. The math there is honestly really hard to wrap your mind around. You're talking trillions of dollars. So they don't have that in their current plan. And to enact tax policy, you need to have Congress. Legislation has to originate in the Ways and Means Committee. You have to go through Congress for something like this.
Do you anticipate Senate Republicans fracturing even further from the president ahead of what the president called yesterday that one big, beautiful bill that he is hoping for that includes those $4.5 trillion tax cuts?
Yes, the Senate is prepared to move forward with something called Vote-A-Rama beginning tonight. It will last 50 hours, and it is a direct defiance of the president's stated preference for one big bill. This is a $342 billion measure that, again, spends hundreds of billions on military and immigration and opening up energy permitting. It does not need to be offset in the reconciliation instructions, and they are moving forward with those votes today in direct opposition to what President Trump tweeted about yesterday.
Henrietta, I'm curious, just given the uncertainty coming out of Washington and given the research that you've done, in terms of what this means for the business community, what have you seen as the impact there?
There's a lot of concern around the tariffs. I would say a tremendous amount of focus on whether the Canada-Mexico tariffs really go into effect on pharmaceuticals, on energy and automobiles. I'm expecting that those get excluded from any tariffs that go into effect on our USMCA allies. But tariffs on China, I think, are taken very seriously. And then the EU auto tariffs also need to be taken very seriously as well. And I think the street's getting to that view now.
Henry, do you think, I would actually ask if the market's still discounting that, though, just the real risk of it, given the fact that it has been able or has shrugged off some of those most recent developments?
Yeah, definitely. And I think that the president does such a good job messaging around tariffs. You float the idea in the Oval Office on January 20th, Inauguration Day, say that there's an effective date by front running your staff that's not even confirmed yet and say they're coming February 1st. And then now we slow walk that all the way through February into March 14th, into March 31st, then all of a sudden it's April. So investors are predictably and sort of justifiably not taking the president seriously. But a close, analyst, someone who follows former USTR Lighthizer, former USTR Catherine Tai, and incoming USTR Jameson Greer and Howard Lutnick should take these tariffs incredibly seriously. Not only do they absolutely have to have the revenue to offset the cost of this tax bill, but the president genuinely believes in the value of tariffs. And I think that there will be substantial tariffs imposed on or around April 1st, potentially with slow upticks, 5% to 10% to 15, et cetera. But the tariffs are coming.
What do you tell clients about how that interplays with capital markets then? Because in the lead up to the election and a lot of our coverage, we were urging people to remember, and investors said on our shows, that you don't want to trade on policy, on a potential election outcome. Is it different with tariffs?
Yeah, I think it is. And I would discourage folks from looking at the idea of universal tariffs and taking the president literally on that one. I'm not a big fan of that opinion just because there are going to be exclusions. So I think the more nuanced investor would look at the tariffs and start to pinpoint individual sectors and start to say, okay, this specific company is going to be hit because we're going after X, Y, and Z. And that's going to be country and product specific. So for example, a Section 301 investigation into India that imposes tariffs as a result of, chemicals and pharmaceuticals, medical devices, that's entirely on the table. Are we going to see tariffs on Mexican automobiles? I don't think so. So you've really got to be very particular about how you play a tariff war. All
right, Henrietta, always great to talk to you. Thanks so much for taking the time.
Thank you for having me.
Continue with the latest out of DC. DOGE claiming $55 billion in government savings so far. Elon Musk's Government Efficiency Commission uploading a list of everything that is cut from the federal budget to its website. Our very own Rick Newman has, of course, been combing through this, analyzing these records. What can you tell us? Where are we saving?
Well, the records that are there don't add up to $55 billion. And I mean, I'm not slagging the DOGE Commission on that. I mean, they only started putting these records up this week. I guess it's good they're putting some records up. But for anybody who hasn't yet had the time to go through all these records yet on their own, so what they're doing is most of the savings that they're putting on this website are contracts at various federal agencies that they say they have either renegotiated or just canceled outright. So when I looked yesterday, I downloaded everything from the site. There were about 1,100 records there under contracts. There's another category called real estate. That's a lot smaller. There are far fewer entries there. So if you just add up all the savings they are claiming from everything they've posted on that site so far, it's about $8.5 billion, not $55 billion. So I can't prove that there aren't $55 billion in savings. Maybe there are, and they just haven't posted it yet. But there's this huge gap, and there are also some irregularities, like the New York Times found one example. I found some others where you look at the amount of savings they're claiming, and then you click on the document that they're directing you to, and the total contract value is less than the amount that they say they're saving. So they're not explaining any of this. That, you know, this is completely unaudited. So I have no idea if any of this is valid or legitimate. I'm just saying what they are showing on their website.
So we don't have the data to back up that $55 billion claim. The data doesn't paint that picture.
So there's data for 8.5 billion of the 55 billion. So is the paperwork coming for the other, whatever the number is, 47 billion? I don't know. Maybe, maybe not. I mean, another oddity of this is they're not telling us a time frame. $55 billion this month, or it could, I think more likely, it's whatever the number is, it's over years, because when you renegotiate a contract, I mean, these contracts aren't just this month. These are 3-year contracts, 5-year contracts. So it seems like they are renegotiating payments that haven't even happened yet, and they could be counting that as savings. I mean, I don't want to just dismiss the whole effort. I mean, there is, without a doubt, there's bloat in the federal government, and they're going after it. But the method to the madness is not yet apparent. Put it that way.
And Rick, there's also the legal side of it too, the challenges that are also playing out for some of the cost-cutting measures and spending cuts that they do want to enact. So of course that also then begs the question about how realistic some of these plans even are.
Nobody knows. Yeah. I mean, this is a gigantic experiment in how we run the country. So everything I was just talking about, all these things that are listed on the DOGE website, none of that includes personnel. And we know from the headlines, they're trying to get rid of thousands, literally, probably hundreds of thousands of federal workers. There are, I think, 3 million. I think the federal workforce is about 3 million people, not including the military. And they so far seem to be going after a couple 100,000. Just to put this in context, I'm sure there's a lot of waste, fraud, and abuse here, but this is not where the big money is. The federal workforce, I think it's like 1.5% of total federal expenditures. All the big money is in Social Security, Medicare, Medicaid, veterans benefits, and defense spending. So the idea that, Henrietta, I loved Henrietta Treyz's segment just before I came on, by the way. She's basically saying, you're seeing little savings over here, but they're massively inflating the deficit and the national debt over here, and she's dead right. So, I think they want the attention to be on the small savings they're getting over here, because of the other part of the deficit is just ballooning.
And to your point, those Medicare cuts that are expected to come in the reconciliation bill, I doubt will be popular with voters.
Trump said this week he said he's not going to cut Medicare, Medicaid, or Social Security benefits.
Right.
Now they are going into they're clearly going into these programs and looking if they can cut overhead.
Right.
The contracts show so far, I think they're claiming $200 million in savings at the Social Security Administration. So I don't, I get, what is that, subscriptions to the Wall Street Journal and stuff like that. I mean, okay, fine. So they're not reading the news at the Social Security Administration. Voters obviously want to know their checks are going to keep arriving. And Trump obviously has to be careful that he doesn't interfere with the functioning of that part of the government.
All right, Rick, we got to leave it there. Thank you so much for
You don't want to
joining
do
us.
DOGE
Always
all day?
appreciate it. We're going to do it in our show later. Oh yeah,
Tease ahead, capital gains.
DOGE
We'll find
all
out a
day.
lot more about it.
We will be talking about DOGE and more later today. Rick,
See you
thank
guys.
you as always. We'll have all your markets action ahead here on Yahoo Finance, so stay tuned. For all of Wall Street's optimism for a business-friendly environment under Trump 2.0, market conditions have proved much more difficult, especially for venture capital. Higher borrowing costs have put a stop to years of easy money, and fund managers are grappling with more cautious investors. Here to discuss further, Bradley Tusk, Veda Partners founder and CEO. Bradley, we want to get your take on the VC environment right now, given some of the pressure that we've seen from policy from the White House and also, of course, from the Federal Reserve. What are you seeing?
Look, VC has been effectively dead for the last 4 years. There's been no liquidity, both in terms of IPOs or M&A activity. And there was hope, especially in the fall, that would change for two reasons. One, the Fed was cutting interest rates, which makes sort of alternative assets more attractive. And two, the idea was with Trump coming in, you would have more kind of pro-business regulation, more pro-business regulators, and that combination. But I think instead what we've seen is A, the Fed is saying, look, we may be done cutting rates, and B, just the federal government is so chaotic that I think the markets don't really know what to do about all of it. And so instead of there being kind of a clear glide path for IPOs and for M&A, it's just chaos.
How much of a chilling effect then do you expect from that?
A lot. I mean, effectively, the chilling effect before was the result of the FTC kind of generally being so anti-M&A overall that it just sort of kept everything at bay. Right now, you might have better regulators from that perspective from the FTC, but when the operating system of governance is chaos at all times, that's not good for markets, right? And so I was hoping that we start seeing some real liquidity in Q1 or 2 of this year, and right now I would be shocked if that happened.
Do you think we'll even see it in the second half of the year?
I don't know. I mean, maybe if Trump settles down a little bit, my kind of hope, and this is possibly totally naive given who he is, but came in with this massive ball of energy, all the stuff he wanted to do, and then kind of once sort of that clears out, things start to normalize a little bit. So I would like to see that happen for lots of reasons. But with that said, he is comfortable in one particular mode. And I think, for him, if anything ever does get too calm and quiet, he will come up with something to shake it up again.
How does that tie into what you think Elon Musk's end goal is? Because I've talked to some people this week who are concerned that all of the DOGE cost cutting is in an effort to privatize some parts of the government that Musk can benefit from, and then others say that's a little bit conspiratorial. He's just trying to cut costs. Yeah,
I think if anything, you're being too generous. I think Elon's end goal is a lot like Trump's end goal, which is a lot like Kanye West's end goal, which is attention. The fact that we are talking about him right now is what he wants, and I'm sure they all prefer positive attention to negative attention, but they would vastly prefer negative attention to no attention at all. And so Elon is a really smart guy. He has done some tremendously impressive things like Tesla and SpaceX and Starlink. But I've also, keep in mind, I've been a tech investor for a long time, but I also worked in government for 15 years at every level of government. And A, he has no idea what he's talking about or what he's doing. And B, and I know people watching this show, because they're all private sector people, won't want to hear this, but running a government at a really high level, like I was the deputy governor of Illinois for 4 years, is exponentially harder than running a company. So many more stakeholders, so many more points of view, so many more inputs and variables that one of the real problems that you see all the time out of Silicon Valley is people don't know what they don't know. They think that just because they went to Stanford or they were a Y Combinator or they made all of this money, they're a genius at everything. Like, no, you're a genius at raising tech funding startup, tech startup funding or engineering or whatever it might be. But the fact that you figure out how to get people their smoothies, a minute faster doesn't make you equipped to figure out what the budget should be for the U.S. Department of Defense.
So what does that then tell us just about how effective or ineffective he potentially is going to be then within this role?
Yeah, I mean, I think more ineffective than effective because, look, as the previous guest said, there's plenty of waste and bloat in federal government, and I think the notion that we couldn't make it smaller or more effective is great, but what he's doing seems to be so without regard to any thought that, there have been more plane accidents in the last couple of months than at any time in recent years. And I'm not directly blaming his cuts and pending cuts to the FAA, but clearly it's not the wrong time to have fewer air traffic controllers, right? And there are just so many different, cutting the DOD budget at a time where there's going to be a peacekeeping force needed of some kind in Ukraine, some kind in Gaza. The world is a volatile place. I thought Republicans were supposed to be for having a strong military, and instead it seems to be the opposite. So, if they were, like with tariffs, for example, there's at least some measure of thoughtfulness around it, right? Like what Trump has said is, we want to sort of study everything, see where the U.S. is being treated unfairly, where other countries are taking advantage of us, and then sort of act accordingly. That makes sense to me, right? Our companies shouldn't be treated unfairly. But with Elon, it's all move fast and break things. And look, when it's your private company with your money and your investors' money, and you want to do that, like that's kind of your business. But when it's 330 million Americans and their lives, that's another story. And that's before we get to the government shutdown in a couple of weeks.
Well, I want to switch gears a little bit and talk to you about DeepSeek before we let you go. How has the introduction of this AI that was seemingly trained for a lot less money than the AI players in the U.S., how has that changed how you are advising?
So it comes down to one question that we just don't know the answer to yet, which is, so DeepSeek says, look, we built this inference model because we had to deal with the U.S. trade restrictions, and the inference model turns out is vastly better because it's at least 90% as effective with a fraction of the compute and energy cost. OpenAI says, no, you trained it on our model, which required all of that compute and energy cost. So ultimately, everything you're saying is totally false. If DeepSeek is right, overall for AI as a sector, that's really good, right? Because it reduces the costs meaningfully, and it means that for the ability of companies to use AI, they're not sort of hostage to a handful of companies like OpenAI or Anthropic or whoever else, and B, the costs that they'll have to spend to get it are a lot lower because people gravitate to the lowest cost technology that can do the job. Now look, there is a real fundamental problem that all of the US AI companies seem to fully believe that the only way to do AI was with hundreds of billions of dollars, if not trillions, in compute power and new energy sources. That's what Stargate was all about, and that might all turn out to not be true. And so what may be to the benefit of AI as a whole and consumers as a whole may be to the detriment of the major US AI companies because they may have thoroughly miscalculated.
Brad, just real quick, we only have about 30 seconds here, but were you then a bit surprised, just given some of the rhetoric that we did hear from some of the larger cap big tech CEOs on their earnings call, kind of doubling down on those spending plans?
I think the problem is, one, there wasn't enough time for them to sort of pivot to a new reality. And so, if investors on the earnings calls heard a lack of confidence, that would have shaken the share price. And I think to a certain extent, our CEOs are so overly held hostage by just what a handful of analysts sort of interpret on a call every quarter. But two, we don't know. So maybe Sam Altman is right. Maybe DeepSeek ultimately cheated all the way through. And you do need that level of compute and energy to do AI right now, in which case they're right.
All right, Bradley Tusk, always great having you.
Yeah, thank you for having me. I appreciate it.
Coming up next, we're going to take a closer look at results from Alibaba. It's on pace for potentially its best day since 2022. We'll talk about some of those gains when we come back.
Shares of Alibaba continuing to climb after reporting a double-digit bump in its cloud segment revenue in the latest quarter. This comes after the company chairman confirmed it will partner with Apple and reports the company's weighing an investment in DeepSeek. Here with more, we got Santosh Rao, Manhattan Venture Partners head of research and an early investor in Alibaba. Santosh, great to have you on. I want to zero in not only on the cloud revenue rise of 13%, but that AI-related product revenue triple-digit growth for the sixth quarter. How is Alibaba becoming such a powerhouse AI play?
Yeah, absolutely. I think AI is going to help their core business. They're using it for their advertising, for their e-commerce, and all that. So I think it's a natural partnership there. So I think that's the key thing, and it's going to help every other company, Facebook and Amazon, to really enhance their product line, their productivity, their effectiveness. So AI is going to help across the board for many companies because of the way it is. So I'm not surprised. AI did help, but I think more than that, their core business did well. Their international sales did very well. Their global footprint helps. And their cloud business, of course, is a good anchor in their business. So I think that it's a good diversified company doing very well on the back of China recovering. The economy is just coming off their back, and the consumer is strengthening, but it's still weak. So there are a lot of issues out there, but I think they executed well. They had the Singles Day behind it also, so that helped also. So I think 4Q had some good favorable wins in their favor, and they are executing very well.
Santosh, how should investors be thinking about Alibaba? Is it simply now an AI company, just given the focus that we have certainly saw or heard on AI when it comes to the earnings call and some of those lofty expectations in terms of that potential growth?
Well, AI is a must. Every company has to use that word. That's like a compulsory, like we had the .com in the past. So AI, everybody's going to use the AI. But I think it's like Amazon. It's a company that will execute. It has a cloud business. It has an AI business. Now it's going to tie up with Apple. It has an e-commerce business and a search business. So it is really wide, has partnerships with many key players. And competitively, it's in a good position. And needs to keep innovating, which it is, because the competition is right nipping away at their heels. So they are executing well. That's the key thing. It's a big business. It's a big company, rather. So that's the key thing. AI is going to be in everyone's vocabulary, every company, every CFO's, every earnings call's vocabulary. AI is a must. And you'll see more and more applications come in there as we get deeper and deeper into AI. And as DeepSeek and other lower cost models come into play, I think the developers are going to find it easier and cheaper to build on top of that. So that you're going to see more and more in 26, 27 when the applications take hold. So it's not surprised. It's going to help more and more, and Alibaba will be a big beneficiary.
Santosh, real quick, we have about 10 seconds. Are you a buyer then of Alibaba at these levels?
Absolutely. I would definitely buy it. It's coming off a very low base. Right. It has it's a huge company, huge market, and it'll continue to do well. I would definitely buy it.
All right, Santosh, thanks so much. Well, that does it for us today, but keep it right here. Wealth is coming up next. We'll see you tomorrow.